Hello and welcome to the Retire Once Show, the show designed to help you get to retirement, but most importantly, stay retired. I'm your host, Jonathan Rankin. I'm the founder and CEO of Theorem Wealth Management, and I'm joined today by my lovely co-host.
Hi, I'm Melissa Rankin. Thank you for joining us.
We are very happy that you're taking the time to be here, especially with everything that's going on in the world and the markets. I mean, last week we intraday hit a bear market in the S&P 500, so
Thanks.
It's been a lot going on. And so thank you for taking the time to watch this. Today, we're going to cover everything about Roths. So Roth IRAs, Roth 401ks, backdoor Roths conversions. If you tuned in last week we covered 401ks and had a lot of questions on just traditional 401ks. And today we're going to cover the Roth side of things. So
Absolutely. And before we get into that, if you haven't had a chance to check it out, Jonathan actually did a market update yesterday. So make sure you check that out because very good information on that.
Thank you for that. Yeah, we're going to try to put those out a lot more often, especially with everything that's going on right now in the markets. There's just so many questions, concerns about, how far is this leg down going to be? What's going to happen?
What does it mean?
Yeah, so we're going to start putting those out on a more regular basis. But today we're going to dig all into Roths. And as always, Melissa, what do we want people to do before that?
We want you to subscribe us, rate us 5 stars, and share it.
Do you remember the share?
Oh yeah,
the
I was like, I remember this hand motion thing. Share it and tell everybody you know to watch the show.
That's right. So thank you for being a part of this community that we're trying to build here. It's our retirement paradise, as we always call it. So with that, let's jump right into Roths.
So with getting into the basics, what is a Roth account?
So a Roth account is an account that has after-tax dollars contributed to it. So it's not like a 401k or traditional account. Money that you put in there came right after Uncle Sam took his cut. All the growth that happens in that account is tax-free. Anytime you take money from that account once you're in retirement is also tax-free. And the benefit is there are no required minimum distributions. So there are a lot of benefits to a Roth account. It's just the reality is you're paying the taxes in the beginning and it doesn't have that tax deferred status like a traditional account does.
Okay, so lots of differences there between a traditional IRA and the Roth.
The other thing about Roth IRAs is that there are income limits and you can be phased out of even being able to contribute to a Roth IRA based on how much you make.
So with that in mind, the phase out period for a single person is $129,000 for 2022, and for a married couple, it's $204,000. Again, that's the phase out portion.
Yep, that's where you start to phase out. And then what are the levels where you just can't contribute to it at any point?
Where you're completely eliminated.
Yep.
So as a single person, not much of a difference from the phase out, but $144,000. And for a married couple, $214,000.
Yeah, so after those points, you can't even contribute to a Roth IRA. So the good thing is that some 401ks now offer a Roth 401k. So if it makes sense for you to contribute to a Roth account in general, that might be an option for you, just because now in a 401k, you have that ability to just have that come out of your paycheck, go right into that account. And there are no income limits on Roth 401k contributions. But we get the question a lot. So what's better? Roth account, traditional account, which one should I be saving in? We get that question all the time.
All the time.
So what we'll do is we'll walk through an example of how this works. So if you earn $1,000 and you contribute that $1,000 to a traditional account, so one that is tax deferred, so you pay no taxes. So that $1,000 you made goes right into the account. You invest that, and let's say that grows by 5 times. So by the end, when you're retired, it's now at $5,000. And let's say your tax rate is 25%. Now you're left with $3,750. Conversely, in a Roth, if you earn that $1,000, let's say your tax rate was 25%, only $750 went to the account. Now, the same 5% growth, guess what? The amount's the exact same, $3,750. There is no difference whether it's a Roth account or a traditional account if your tax rate is going to be the same.
So that's the key point. If your tax rate is the same.
That is the total point that you have to start thinking about whether or not a Roth is the right decision or not. Is if your tax rate today is going to be lower than what it will be in retirement, then a Roth makes sense. However, if your retirement is going to be at a lower tax rate, well, then a traditional makes sense. So it's always a matter of, the goal is you want to pay Uncle Sam as little as possible.
Absolutely.
So whenever you feel like you're going to be in a lower tax bracket, that's when it makes sense to contribute to a Roth account.
And didn't you also say that aside from like your regular income tax, isn't state tax something to consider also?
It is, especially if you consider moving in retirement. A lot of people will, if you're living in a state like California or New York with an extremely high state income tax, if your plan is to, move to, let's say, Florida for retirement, well, you're going to be in a lot less of a tax bracket overall because you have no state income tax in that state. So factoring in your total tax rate will be important. Now, if you're in your 30s, it's going to be hard to know if when you're in your 60s that you're going to relocate to Florida.
Live.
Yeah. So that is the hard part. We can't predict, what future tax rates are going to be, and people change their minds all the time. So to think that, hey, in 30 years, exactly where you're going to retire, it might be tough. But if that is a plan of yours, then yeah, you might want to look at, if I'm going to live in a state where my tax rate is going to be lower, then maybe it is important just to go traditional right now because eventually it'll be in a lower tax bracket.
Okay, so with state tax in mind, when is a Roth better?
So a Roth is going to be a better decision if you have the opportunity to take advantage of a Roth 401k and can just max that out, because you can contribute the same amount as you could to a traditional account. However, all of that growth and all the distributions are then tax-free. Whereas in a traditional account, you don't get the opportunity to contribute more just because it's before tax. You get to contribute the same amount as a Roth 401k. So if your taxes are the same, you're going to end up with more money in a Roth account if your tax rate is the same, just because of the fact that you're contributing after-tax dollars.
Okay, so then when is a traditional better?
So the traditional is better because it does give you that flexibility, which is important because like we were talking about, you don't know what tax rates are going to be. You don't know where you're going to live. Things happen in life. There might be a year where you have a very low income tax year, and that might make a good year for a Roth conversion, which we're going to get into in just a few moments. But really, a traditional IRA gives you flexibility to choose when you pay taxes, whereas once you contribute it to a Roth, that's it. You paid Uncle Sam.
Game over.
He's not going to just let you undo that just because you feel like it. So it's really about that flexibility that the traditional gives you. Now, there is no rule to say that you can't do both. And obviously, there are income limits on the contributions. But the reality is, if you're able to do both, there is no rule that you can't. Even with Roth 401ks becoming more prevalent, having that asset location diversification does make sense because we don't know what future tax rates hold. We don't know where you're going to live. So there's a lot of unknowns in the future. So having assets in both types of accounts could be a very good idea.
Kind of covering both sides of it just in case.
Yeah, absolutely.
So you mentioned Roth conversions. Can you explain what those are?
Yeah, so right now with the market down, there's been a lot of conversation and a lot of headlines that you'll see talking about now being a good time to execute a Roth conversion. So these aren't the same as a contribution. This isn't you just putting money into an account. What you're doing is you're taking assets that you have that are in a traditional IRA, or let's say you had an old 401k and you rolled that into an IRA. You've got these assets that are there in pre-tax dollars. What you're doing is then you're converting those into a Roth account, but you're paying the taxes today. You're doing that to get all of the benefits of the Roth. So you get the tax-free growth, tax-free distributions, no required minimum distributions. You're doing that, but you're paying the taxes today.
So again, that goes back to your tax bracket.
It does. Now, you can convert all types of traditional accounts. So you can convert IRAs, 401ks, SEP IRAs. The one traditional account that you cannot convert is an inherited IRA. So if you inherited something from a parent or a loved one, you can't convert that into a Roth. That has its own rules on it. So let's just imagine that you were saving in your 401k for 40 years. You started when you were 25, you just turned 65, and you're hearing, I really like this idea of a Roth account. I want to make sure that I never have to pay tax on this money again. You theoretically can convert that entire $1 million into a Roth account today. Now, you'll get all the benefits of the Roth. However, when we go back to the reason why you want to do a Roth, you want to do it when your tax rate's at the lowest. And I'm pretty sure when looking at the tax chart, $1 million pushes you into a much higher tax bracket.
Right.
So, the goal is to pay Uncle Sam as little as possible. That's always what we keep in mind. And one thing to note about Roth conversions is that you can't undo them.
So once it's done, it's always
done,
always going to be a Roth.
It is done. You cannot put the toothpaste back in the toothpaste tube. It's just not possible. Trust me. I've asked our 5-year-old to try.
And he has.
So it's not something you can undo. So doing that, you really want to do a lot of planning in advance. You want to make sure that you're understanding your tax rate today, making sure that you're not going to push yourself into a higher than usual tax bracket this year that might not be the best time to actually do that conversion. So, and the other thing is that if you're using those converted funds to pay for those taxes today, because if you're under 59.5, you're likely going to be subject to the early withdrawal penalty of 10%. So you're adding a penalty on top of the taxes that you're paying right now if you're under 59.5.
So that probably doesn't make sense then, because you're paying the penalty and the taxes.
Exactly. And that's only if you're using the converted funds to pay those taxes.
Okay.
So if you've got money in a savings account that you just want to, do this conversion, pay Uncle Sam with those dollars, there is no penalty on that. You're just paying ordinary income tax. The other thing to keep in mind is that it's not a good idea if you need the funds within 5 years. So let's just say that you're 65 years old today. You want to convert $50,000 into a Roth, and you do that. You convert $50,000, and over the next 4 years, that $50,000 grows to $200,000. Really good market. Triple your money in 4 years.
That sounds great.
Really good market. Now you want to withdraw that entire balance. For some unforeseen circumstance, you had a emergency, you need to withdraw all of that money. Well, because it's within that 5-year rule for a Roth, now that $150,000 of growth is now taxable. And so you miss out on
the whole 150.
Whole 150. All of the growth is now considered taxable, and you miss out on all of the benefits of the conversion itself. So
you shouldn't have done it in the first place, theoretically.
You shouldn't have. You should really make sure that if you're doing it, that these funds you can they're for 5 years plus. You don't want to have to tap into those funds within the next 5 years because of that 5-year rule.
Okay, so now we've covered all of the Roth conversions, and you mentioned earlier a backdoor Roth and a mega backdoor Roth.
Yep. So
can you explain those?
Yeah, so these are for individuals who phase out of income limits. So as you talked about, the income limits for the complete phase out is what, $144,000 for a single individual,
and $214 for married.
$214 for married. So when you hit those limits, you can't contribute at all. So let's talk about the backdoor Roth. So what this allows you to do is you make non-deductible after-tax contributions to a traditional IRA. So you open a traditional IRA, you make after-tax contributions. Now, right now, 2022, you can contribute $6,000 if you're under 50 and $7,000 if you're over 50. And you can do this for a married couple, so you can each do a traditional IRA contribution. And then what you do is you immediately convert those into a Roth IRA. So you're contributing after tax and then immediately convert that into a Roth IRA. This way, you want to make sure there's no growth in the account because then that will trigger some taxes. The other thing that's important to keep in mind is what's known as the IRS pro rata distribution rule. So what this does, this is triggered upon conversion. So the IRS looks at all of the IRAs that you have.
So everything you've got.
So all IRAs, all simple accounts, all SEP IRAs. So if, let's say you had, going back to last week's episode, you had 4 employers and you roll those into 4 different IRAs. The IRS is going to look at and aggregate all of those 4 IRAs.
The whole picture.
Yep. So let's go through an example. So you have $5,000 right now in a traditional IRA. So all of those funds are untaxed. Now you want to make a $5,000 non-deductible. Now you want to make a $5,000 non-deductible after-tax contribution.
Okay.
So because of that pro rata rule, they're going to aggregate those IRAs. So now you have a total of $10,000 in IRAs. 50% or $5,000 is pre-tax. 50% is now that after tax. So you want to do a conversion of that $5,000 that you contributed after tax. I mean, that was why you did it in the first place.
Right.
However, because that pro rata rule, half of that distribution, that $5,000, half of that is now subject to tax. So $2,500 is subject to tax because the IRS doesn't look at it like you only have $5,000 of an after-tax IRA. They look at it as you have $10,000 of
Total.
IRAs total, and half of that is pre-tax, half of that is post-tax.
Okay.
So if you're going to do this, you got to make sure that you're aggregating all those accounts, that you have a full understanding of what you have out there in terms of IRAs, because if there's a forgotten about IRA, like we talked about last week, the last thing you want to do is forget about an account, and then all of a sudden you go to do this contribution and you end up not being able to do it, or it doesn't work out as favorably as you wanted to.
And I assume just like with the Roth conversion, how there's no going back. Once you've done it, it's done. Same applies here.
Irrevocable toothpaste tube.
Okay.
Exactly.
All right. So now that we've covered the backdoor Roth, what about the mega backdoor? What is that?
So the mega backdoor is the 401k version of a backdoor Roth IRA. So this allows you to make after-tax contributions to your 401k. And then what you do is you convert those funds while you're still employed into a Roth IRA.
Okay.
So this only works if you're employed and your plan allows for after-tax contributions, and it allows for in-service distributions of those after-tax funds. So you want to make sure that your plan allows that first before doing it. And typically what you do is you fund up to the salary deferral. So you essentially max out your 401k, either pre-tax or Roth.
Again, we covered this last week on the 401k side.
And then you make after-tax contributions to that account. Because a 401k has much higher contribution limits than an IRA, you can put more away. The salary deferral limit is $20,500 for someone who's under 50 and $26,500 for someone who's over 50. Now, in a 401k, there are maximum annual contribution limits. So what they do is you sum up all of the contributions. So whether that's your employer match, your employee contribution, and you add those up, and the total that you can put into every single year is $61,000 if you're under 50, or $67,500 if you're over 50 years old. So let's just, for round numbers, say that you're 40 years old. You've got $20,500 that you put into your 401k. Your company matches you $9,500. So $30,000 is going into your 401k. You can contribute on an after-tax basis $31,000 to get up to that $61,000 limit. So that $31,000 now, you can convert that into a Roth IRA. As you could see, you could put a lot more into a Roth than what you could do on just a backdoor Roth IRA. So
assuming your plan allows it, that's where it would make the most sense if you want to kind of maximize what you can actually contribute and put in.
It is. So this really makes sense if you just have, if you're just a good saver, you just love saving, and that's, what you do. You've got the ability to do that, and you can put away an additional, $31,000, if assuming that's the match that your company has. Yeah, it's a great place to save. Now, similar to a backdoor Roth, distributions are done on a pro rata basis. So that is typically 401ks will keep track of the after-tax count separately. So hopefully your plan does that and doesn't make you have to
keeps it nice and clean for you.
Yeah. So a lot of plans, if they offer this, usually will have that separate accounting, because your gains, you contribute after tax, and let's just say that you were investing in a brokerage account with those after-tax dollars. Well, you would have capital gains if you buy and you sell things over time, whereas in a 401k, those after-tax contributions, all the gains are untaxed until they're distributed. So let's look at an example here. You've got this after-tax account. You've contributed $60,000 to it, and it grew by 40. So now you have $100,000 of an after-tax account within your 401k. $60,000 is contributions, $40,000 is growth.
So let's keep it simple. Say you wanted to do a conversion for half of it, $50,000.
So what you can't do, you can't just cherry pick and say, okay, that $50,000, I want that to come from the contribution so that's completely tax-free. No, what they do is they say, well, 60% of your account is contributions, 40% is earnings. So out of that $50,000, 60% is going to be contributions. So in this case, $30,000 will be considered contributions. 40%, so in this case, $20,000 will be considered earnings. So now that $20,000 of earnings will now be taxable.
So that's where it gets a little bit tricky.
It does. And now there is a tax-free alternative. So you can split the proceeds. You can put that $30,000 into a Roth, and then you can actually, that $20,000 can be rolled over into a traditional IRA tax-free. Now, the reality is, though, is that you now have to wait until you're 59 and a half. It's got the same restrictions as any other traditional account. So that might not be as advantageous to you, but at least you're not coming out of pocket that year to pay those taxes. It is a tax-free option, though. So
with the Roth, the mega backdoor Roth, all of that, I mean, I feel like the main point here is your taxes.
Mm-hmm. It all comes down to, when are you paying taxes at your lowest tax rate? That's all that matters.
That's the most important part.
Yeah. All of this stuff sounds fancy. You know, when you're on the golf course with your buddies going, I did a Roth conversion and I did this mega backdoor. Well, if you're in a 37% tax bracket and you're eventually going to be in a 25%, that's nothing to brag about.
Right.
You know, the goal is
poor
that
planning.
Yeah, you want to make sure that you're doing a lot of planning around these, because a lot of them are irrevocable. You want to make sure that you are, that you're trying to forecast, when are you going to be in a lower tax bracket, because that's all that matters. As complicated as these things get, it really comes down to, when are your taxes going to be the lowest, and let's pay taxes in that year. And the traditional account, like I mentioned, that offers the most flexibility, because you can do some of these conversions over time. That gives you the flexibility to, try to determine when the best time might be to pay those taxes.
But again, it goes back to every individual's personal situation and kind of where they're at tax-wise.
Yep. Everybody is different. And that's where one of the things that we can do, we can help plan this out for you. We can go through some modeling with you and build out that retirement analysis. See, does a Roth conversion, a Roth account make sense for you based on where you're at today? We'd be happy to do that. We're going to link to the ability to schedule that analysis with us in the show notes below. But before we get out of here, what do we want people to do?
We want you to like us, subscribe, share, rate us 5 stars, and again, tell everybody you know about the show.
Absolutely. Tell everybody you know, join our retirement paradise. Keep your head above water out there. I know there's a lot going on. With that, I'm Jonathan Rankin.
And I'm Melissa Rankin, and be on the lookout for our next update.
Theorem Wealth Management is a group of investment professionals registered with Sanctuary Securities Incorporated, member FINRA and SIPC, and with Sanctuary Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Sanctuary Securities Incorporated, and advisory services are offered through Sanctuary Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not guaranteed. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Theorem Wealth Management and Sanctuary Securities Incorporated or Sanctuary Advisors LLC shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This presentation was created for informational purposes only. The opinions expressed are solely those of Theorem Wealth Management and do not represent those of Sanctuary Securities Incorporated or Sanctuary Advisors LLC or any of its affiliates. Sanctuary Advisors do not provide tax or legal advice. This material is not intended or written to be used or represent to any entity as tax advice or tax information. Tax laws vary based on clients' individual circumstances and can change at any time without notice. Clients are urged to consult with their tax or legal advisors for any related questions.